This is question number, I guess, 6 from homework 3 for chapter 4. So we're provided with the financial statements of this company, and we also know the industry norms by clicking on this pop-up window. So we have different parts, and part A is to compute the ratios in the pop-up window for 2 years and then compare both against the industry norms. So let's see. A is first one is current ratio, and let's note the rounding requirement. Round the numbers to 2 decimal places and select your evaluation from the drop-down menu. So first one is the current ratio. Industry norm is 5, and let's say current ratio is defined to be current assets divided by current liabilities, right? So let's say, oh, this is the table for the industry norms, and so let's click on this. So current assets, oh, good. So now it has the function to actually, you see, we can click on this and copy this to a spreadsheet. So that's great. So and let's do that. Open in Excel. So now I think my lab has realized, remember, as I said, um, it's a bit inconvenient. Doesn't look to be very user friendly yet. So let's see, is any copy to clipboard, and then let's see, can I manually copy this or paste this? So let me try this. Oh, what's that? Okay, so then copy, and then let's paste the special, and let's use text. Wow, it looks like this is slightly better, I guess. At least, so let me compare this with the original number, see whether it matches. Okay, so 202, cash, accounts receivable 447, and current assets 1203, and plant equipment, good, and depreciation, and then net plant and equipment, and total assets. So the only numbers which seems to have some issue is the total assets. So let me get rid of this symbols and okay, so it's good. Get rid of this. All right, so basically I have manually edited this table. So now I think this matches the original content, and you can see that. So that's the balance sheet. And now if we do the same for the income statement, probably, let's see, is the income statement is the schedule, because I guess eventually we have to use both. So also do some manual editing. It's much better than before, even though it's not perfect, I guess. It's not perfect yet. Okay, so we got both balance sheet and income statement. Again, going back to our first part, which is the current ratio. right? So current ratio is current assets divided by current liabilities. So current ratio is could be calculated from the balance sheet, right? So that equals current assets is right here, and divided by current liabilities is right here. So let's follow the rounding requirement, which is to round to 2 decimal places. So let me change the format cell, and then choose number, and then keep 2 decimal places. And now I can drag the cell to the other year. So this will just delete this empty cell here. And so this is automatically calculated for the other year. So then just copy the answer back to the my lab. So make sure it matches the years. Yeah, 2017 is to the left and 2018 is to the right. So once we compare this with the industry norm, we can see that in 2017 it's greater than the industry norm, but in 2018 it's actually smaller than 20 an industry norm, because current ratio is a measure of the liquidity position of the firm, right? So we can see that based on this comparison, that the liquidity position relative to the industry norm has deteriorated between 2017 and 2018. And this is, we can see this is pool, right? Because it's lower than the industry norm and it's decreasing between these 2 years. So now let's check our answer, and I think we can proceed from there. Okay, so and then acid test ratio, which is also called quick ratio. Again, the rounding requirement is to round to 2 decimal places. Same thing as current ratio. So acid test ratio is defined to be, so let me call that quick ratio here, is that the numerator compared with the current ratio, we only include cash and accounts receivable. So just add cash and accounts receivable and use the parentheses because we want to do the addition before we do the division of the current liabilities later. Current cash plus accounts receivable, and close that, and now division, divide by the same thing as the current ratio. So that's the quick ratio, and then we can format the cell the same thing as what we did earlier for the current ratio number, and then keep 2 decimal places, and then drag the cell to the other year and delete this empty cell and copy this back. This is for 2017, and for 2018 we can see this is also deteriorating, right? It's similar to the current ratio, so this is also pool, and check the work. So just continue this inventory turnover. So inventory turnover is defined to be cost of goods sold divided by inventory, right? So that's the definition of the, let me add one more, just delete this and add one more row, maybe 2 more, just in case we want to calculate more ratios later. So inventory turnover, this is defined, again, this is, so now we need information from both balance sheet and income statement, because the numerator is the cost of goods sold, which is from the income statement, but the denominator is the inventory, which is from the balance sheet. So this equals cost of goods sold and then divided by the inventory. Inventory is right here. And then drag the cell to the other year. So just make sure we followed the rounding requirement 2 decimal places, and same thing as earlier. So delete this empty cell and just copy this number. Um, So we can see that the higher this ratio, which means that the faster that inventories are converted into sales, hence the cost which are associated with those inventories can enter into the cost of goods sold faster. And we can see that it has been improving over the year, but still this is smaller than the industry norm, right? Even though it's um, improving slightly, but still it's less than industry norm. So we can still say that this is poor. An average connection period. So average connection period is defined to be, first it's based on the um, accounts receivable, right? Accounts receivable turnover. And then we use the average connection period, right? Average connection period is basically the number of days in a year divided by this accounts receivable turnover. So once we know the accounts receivable turnover, we can use this formula also to get the average connection period. Accounts receivable turnover is defined to be the annual credit sales, right? So it's an annual credit sales. Now, if we go back to the lecture slides, just make sure we got the right formula here. So it's annual credit sales divided by accounts receivable, right? And then we use 365 divided by accounts receivable turnover, and we get the average connection period. So and then we have to make sure this, we know that sales we can find easily from the income statement. So just put the sales down. But then not all the sales here are credit sales. But what we need here is the credit sales. So then we'll have to use another um, assumption, which is provided by the setup. 15% of sales are cash sales, with the remaining 85% being credit sales. So this is the total sales. This includes both cash and credit sales. And we are provided with the information that 85% of this is credit sales. Hence, we can multiply this by the 85%, and this is the annual credit sales. And then we use that to divide by the accounts receivable to calculate this accounts receivable turnover ratio. Notice here, I don't have to worry about the rounding here because this is not the final answer. The final answer is average connection period. But once we know the accounts receivable turnover, we can use the 365 divided by this to get the average connection period. Basically, the average connection period means that how many days does it take to connect one pile of accounts receivable. Uh, so now this is what we need, rounding this to the two decimal places. And you can see this has been decreasing over the year. Basically, we want this average connection period to be lower, right? Because when it's lower, it means that it's taking less time for the firm to connect cash from those customers who paid by credit. So this is how we can interpret this, and it's actually indeed. So I don't know why this is. So let's still use the format cell function, and we want to use the number and keep two decimal places, and then drag that to the other year. So now I believe if you copy this, it should only give you this. This is not very friendly. And copy the other year. So this is actually improving, right? But before we draw that conclusion, then we have to, it's improving over the year for this firm, but again, this is still longer than the industry norm. So relative to the industry, it's still poor. So check our answer. So here actually we are doing two types of comparisons. One is against its own past. The other is to compare with the industry. And I guess the evaluation, the conclusion for the evaluation is just based on whether uh, it's uh, it's worse or better compared with the industry norm, rather than whether it's improving over time for the same firm. So the rounding requirement for the new debt ratio here is the same as before. And debt ratio, we know this is defined to be the total liabilities divided by the total assets, right? That's how many of the assets is financed by debt rather than equity. So then we have to probably insert another row here. Why don't I give two or more spaces just in case I need those? So debt ratio, this is total liabilities. So this is total debt, and then divided by the total assets. And based on the balance sheet identity, total assets is just the total liabilities and owner's equity, right? So, and then just make sure we followed the right format. And this is in percentage term, and we have to keep two decimal places. So we just follow that, format cells, use the percentage, and keep two decimal places. And then drag the cell to the other year, and then copy the number back. So probably here we don't want to copy, because when we copy this, we also copy the percentage sign, but we don't want to do that. So we just type this 33.33. And for 2018, it's 34.60. And this is larger, right? It's firstly, it's increasing over the year, and also both numbers are larger than the industry norm. And we know that when the firm borrows more debt, um, so I guess this is from the perspective of whether it increases the likelihood of default. Uh, so when the firm has more debt, because debt paying the interest is an obligation for the firm, right? So when it has more debt, means that it also has more interest as an obligation to make the payment for. Hence, it increases the chance for the firm to default. So we can see based on this number that it's higher than the industry norm. Hence, it's relatively speaking, this is poor. And times interest earned. So this is also called the interest coverage ratio. So this is defined to be the EBIT, or operating income, divided by the interest expense. And both numbers are from the income statement. So we can just use the PIE times the interest earned. This is operating profit, right? That's operating income, and divided by the interest expense. And let's say what's the rounding requirement? I guess it's the same. So just make sure this is format the cell to follow that. And we don't want to use the currency, we want to use the number and keep two decimal places. And then drag the cell to the other year, and then copy this number back to my lab. And this is 2018. So first, this numbers is increasing over the year, so it's improving, right? Because we want this number to be high. When it's higher, it means that the firm is in a better position to cover its uh, interest expense, to making the payment for the interest expense. But this is even though it's improving over the year, but both numbers are lower than the industry norm. So relative to the industry, it's still the performance is still poor. Okay, so total asset turnover. So this is defined to be total asset turnover. This is defined to be how many sales are generated per dollar of the assets. In other words, this is defined to be total sales divided by total assets. Right, so this is sales and divided by total assets. Again, I'm using the balance sheet identity, just use the total liabilities and owner's equity. Um, they should balance the total assets. So make sure I just followed the rounding requirement. I guess it should be the same as before. I guess that's what we have over there. So round to the two decimal places. Okay, and then drag the number to the other cell, and then copy this number back. So both numbers are lower than the interest loan, which means that performance is poor. Okay, fixed asset turnover. So relative to the compared with the total asset turnover, the difference here is the denominator. Instead of having the total assets as the denominator, now we are using the net fixed assets as the denominator. So net, it's called a fixed asset turnover, right? So it's total, again, the numerator is the same, but the denominator has changed to the just the and then we have to look for the information from the balance sheet. So it's the total fixed assets. Here is just the net plant and equipment. So, and then we have to make sure this is followed the rounding requirement. Format sales and keep two decimal places and extend that to the other year and format sales by formatting the sales and see we can these numbers one is very same as the industry norm, but the other one is improving. So fixed asset turnover actually this is satisfactory. Okay, so operating profit margin. So operating profit margin is basically operating profit margin is defined to be operating profit divided by sales, right? So this is telling us for each dollar of the sales, how many operating profit are generated. Again, I guess we also need to keep this to two decimal places and drag to the other cell and then copy this number back. I guess this is I'm sorry, I guess this is following the percentage format, so I have to adjust this and make sure. Oh, actually, yeah, that's why we need to be very very careful. Here actually is asking us to round to one decimal place instead of two, so I have to adjust this. First use the percentage format and then just drop one decimal place and then extend this to the other year. So, and then I think it's better to manually type because I don't want to copy the percent sign. For the other year, it's 25.7. And one of the year is less than industry norm. First, the higher the profit margin, the better, right? So, but the other year is actually better, and it's improving. So actually, this is a tricky position, but I think we should look at the latest number, right? Relative to the last year, it's improving, even though last year was the slightly worse than the industry loan, but this year is, by this year, I mean 2018, it's improving, and now it's much higher than the industry loan. So from that perspective, I guess we should say this is satisfactory. Okay, the return on common equity. So this is defined. So this is just ROE, right? This is defined to be net income. So that's the numerator, and denominator is just the common equity, right? And then we can find that from the owner's equity here from the balance. So again, we need to be careful about the rounding requirement. Round the numbers to one decimal place. Again, this is in percentage and selective evaluation from the top-down manual. So, and format the cell here and use the percentage format and just keep one decimal place. And then drag the cell to the other year and manually type this to be 9.0. The other year is 14.4. So this is 2017 is the same as the industry norm, but the 2018 is much higher than the industry norm. So we can see this is satisfactory. Fantastic. Okay, so we're done with part A. How liquid is the firm? Overall, happening is so liquidity here actually, I guess we can look at the two ratios we just calculated, right? So one is the current ratio because we check the categories of the ratios. Liquidity here we have two ratios, current ratio and acid test ratio or quick ratio. So we have done the calculations for both, and then we find that both is poor. So we can see that this is actually is less liquid than the average company in the industry. Okay, so and then part C, are its managers generating an adequate operating profit on the firm's assets? Given the no operating return on assets for Pepling relative to the industry, and so we calculated earlier what is the operating return on asset. We haven't done that calculation yet. We must conclude that management is not doing an adequate job of generating operating profit on the firm's assets. So I guess to answer this question, we have to do a calculation for the operating profit, operating return on asset, right? But so far, I guess we haven't done that calculation yet. But once we know that how this is defined, this is not so hard. So operating return on asset, this is defined to be operating profit, right? That's the numerator. And denominator is just the total assets. So just use, again, the balance sheet identity. So this is, let me use this, put this in the percentage term. Here I don't have to input a number, but just for ease of exposition and extend that to the other year. So, and then we just, to see that whether this is doing an adequate job or inadequate job compared with the industry, we just need to compare these ratios relative to the industry. So we just click on the other table to find out what is the operating profit, um, operating return on asset for the industry, right? So here you can see that it's not directly provided. So before we hastily conclude that here actually we can't compare, we have to remember there's some relationship between these ratios. If we go back to our lecture slides, we can find that the operating return on asset is actually has a relationship to the other two operating return on asset. It has a relationship to the other two ratios. One is the operating profit margin. You see the disaggregation of the operating return on asset. This equals operating profit margin times the total asset turnover, right? So even though here we are not directly provided by the operating return on asset, But we can actually, once we know the operating profit margin and the total asset turnover, we can do a sort of estimation for the operating return on asset and get that information. So that means we can just multiply this operating profit margin by the total asset turnover of 0.75 and try to figure out what is the average level of the uh, for the industry loan. So it doesn't tell us the year. I guess we can assume this is applies to both years. So this is again, this is operating profit margin. This is 20.0%. Then times the total asset turnover, which is 0.75. So and then use the same format as the ratio for this firm. So it's percentage, and for this year it's also the same. So now we can see something about this operating return on asset, right? Because both ratios of the firm actually are lower than the industry loan, which are estimated from the numbers provided. So we can see that this is actually not adequate. Right? We must is not doing an adequate job of generating operating profit on the firms. So this is actually true, right? This is actually true. Check answer. Okay. So I guess we are approaching to the end of this exercise. Part D, how is the firm financing its assets? The firm is financing its assets with 34.60% in and 65.40%. Basically, if you add up these two numbers, you get one, which means that one has to be debt, the other one is equity, right? So you can, once you click on that, it goes to find this number. So I guess we have found this debt ratio right before. We just check whether the debt ratio is, yeah, the latest year is 34.60, 34.60. So this is obviously this is debt. Hence, the remaining is financed by equity. So this part of the question is relatively straightforward. So now we are down to the rear final part E. Are its managers generating a good return on equity? So we have done this calculation also. I guess that's the last ratio we calculated. We see this is satisfactory, right? Because both ratios, one is actually the same as the industry loan, but the other one has improved significantly over the year. So I guess the statement here is that Papling has improved its return on common equity from this to 14.4% compared to an industry norm of so this is true. Actually, yeah, this is true. So check our answer, okay? So I guess we are done with this question.